I'm Jared Johnson, and on this episode of the Stock Market Playbook, we've got Matt Caruso. Matt has a super no-nonsense approach to finding trading ideas, managing his positions, entries, exits. It's a great discussion. Plus, see some of his favorite charts and companies that he's looking at right now. I think you're going to enjoy this episode. Take it away, Matt. Okay, Matt, thanks for joining us on the podcast. Happy to have you with us all the way from
Montreal, so a little bit north of you.
A little bit north of me. So a couple of guys waiting for, maybe not waiting for winter to hit, but it's coming either way. So
we both like skiing, so it's all right.
It helps. Although, we had this past winter that like skipped over. So then it's just, but should get some good skiing in. So looking forward to it. But I'm happy to have you on the podcast today. I feel like there's so many topics and themes underway in the stock market right now, in the economy in general, just in everything. So there's a lot of stuff to dive into. But give everyone kind of a quick intro. Tell everybody who Matt Caruso is and
Sure.
kind of how you got here.
So I've always been kind of obsessed with markets since I was about a teenager. I found the book How to Make Money in Stocks by William O'Neill and said, whoa, this is like suddenly like just blew me away in terms of seeing that there's ways to kind of know when to buy and sell stocks and all like that's possible. And also kind of his process of like finding these interesting companies and like why they won and then timing it with charts. Super. And then I kind of became a market addict even while I was still in college, university. And so out of school, I was fortunate. I did a lot of trading while I was in school and got a market making gig right out of graduation. Did that for almost about a decade's time. And then after ultimately the rise of the machines and the HFTs I took a lot of that business away. And so I kind of saw writing on the wall and I'd always run multiple strategies. So it was I said, you know what, I'm just going to fully, by then, thankfully I built up like enough capital and all the rest. I decided to kind of focus on just thematic growth investing and all, which has past few years actually been good timing for that. And so 2020, I joined the U.S. Investing Championship, which is a real money championship. And so I one point I was in first, and I finished one of the top places. And from there, came Caruso Insights, where I can share my insights and connect with people. And it's just been a really fun journey. And I live for markets. So we were talking about that before. Every trader has that in common. It's not really work. It's just the passion that you get to do every day.
No, for sure. Whether it's just a, average everyday trader or obviously people that, have a audience and groups and so on. It's so interesting. I don't know why the stock market can never get boring, right? I've never heard anybody say, people quit trading because they get frustrated, right? Or they don't have the right money management or whatever, but nobody's ever like, it was just a snooze fest. I got tired of it. Who cares about trading? Like, it's so engaging constantly. It's something that is always changing. You kind of have to ride the wave and adjust and evolve with the market. And so there's some of us that are glutton for punishment. We just keep coming back for more.
Yeah. Well, the funny thing with the market is it's kind of like, it's always similar, but it's never the same. So it's like you always feel like, oh, I figured it out, but like every pitch is going to be a little bit different. So it always has you guessing regardless, So that's the beauty of it. It's I always feel like it's something that can't be solved, and it's human nature on display. And it's just if you really want to learn everything about yourself, it's probably more expensive than a therapist, but you'll learn everything about yourself through trading. You find out your strengths, your weaknesses, and there's nothing like it, I don't think.
For sure. I love, in the book, Mastering the Market Cycles by Howard Marks. Greatest book. Everybody needs to read that. And I love how he just, about every chapter, he says, I still love the saying, this time it's different. Because you're right. It's, we always think this time it's different. And it really never is. It's just, certain adjustments have to be made. But it's a fun, challenging thing. So, I want to dive into, there's so many things kind of happening right now, but let's talk a little bit about your approach. How are you, how do you go at the market on a daily basis? And what are some of your favorite kind of themes and things to look at?
Yeah. So I'm a bit of a hybrid trader in a sense, because again, like the first thing I kind of found and what I look to implement now is kind of like the playbook of William O'Neill, which is finding these great growth stocks, holding them for, sometimes you could show a year or two. I never last that long. I'm usually like multi-month is my personal wheelhouse. But a lot of people will kind of like sometimes tag it like momentum investing or breakout investing. But then, the funny story I always kind of tell is at one point I was kind of market making, and I was fortunate. We had a lot of flexibility with capital. You could hold whatever you wanted overnight as long as you didn't breach like risk protocols. So at one point I kept all of I said, look, I'll day trade, do all I got to do, and at night I'll dedicate it to growth investing with all my capital overnight. And so at one point I was trying to implement these strategies, in tandem, and I was really good at what I did. Like I made money like almost every day. It was just like good, consistent income and all this stuff. But then it's like every time I was buying these breakouts, I just kept losing money. So I'm like, what is up? Like, at the end of the month, it's like you almost don't see a week, but at the end of the month or a couple, you look back, you're like, well, I don't understand. I make like 150 trades a day here, and we're always kind of making money. And here I'm not making anything. So I kind of just like I kind of start dissecting all the rest. And so not that breakouts won't work. They'll work only at the beginning of a new bull market. That's like a small little kind of footnote that should be more than a footnote. But just what I eventually settled on was I kind of agreed with everything with Bill in terms of how to find these great companies and the paths that they're going to take and how the price action will go off. I said, but the timing of things, I've been, like I said, day trading things for like 10 years. Like I know I could find some other time to buy a stock than just the most obvious breakout. So I use, so day to day, it's like, I'm looking for these great companies, but I then bring in a lot of the timing elements that I learned when, I had a prior kind of job and focus of like day trading, swing trading, essentially type of thing where you're holding stocks for a few days. So a bit of a hybrid with a longer horizon of where I try and hold things, but the timing can ironically sometimes be similar timing for very short-term trading.
Interesting. So in kind of that as you said, the obvious breakouts, and that was kind of
Mhm.
challenging. And so what did you kind of settle on as far as the entry goes? How are you getting into, I mean, I want to dive into how you find the company in the first place, but also
Yeah.
like that final entry. So are you away from breakouts? Are you,
I almost never want to buy break and like I said, unless it's like literally we're coming out of a correction, like the first stock to go to new highs will often have so much momentum. But that's like a really small amount of the time. Like most times I won't fade the breakout in terms of go short. Like one of like my favorite entry techniques is like after a breakout, there's almost always a pullback down to let's say a 21 EMA. And if you do the math, it's always like 90% of the time it's going to be a 10 to 15% correction, which is essentially usually always enough to kind of shake out momentum type traders who are just buying breakouts. And again, having been a day trader, market maker, there's plenty of HFTs and algos who are really focused on that cohort of people to kind of move markets where they can to kind of get these kind of moves. So like that's something I'll focus on around the breakout. But like a big part of what I do with which many other traders as well, like really a focus on finding areas where volatility will tighten. Finding like descending trend lines where things have been consolidating and we have an up move, but that are less obvious than like the clear high in price action. And I just, one of my preferences, like I said, either buying like that. I always try and think of like what is the short term positioning of traders, and that helps me to define my risk. And on the snapback, it's easy. Like the short term people are washed out. That's easy to understand. But what's nice about like if you can find periods if the stock is acting well where volatility tightens, well, one that's healthy in an uptrend, and two, if you're wrong, well, your risk is much smaller because price action has tightened up recently. So I'm always very like risk reward oriented, and that's kind of like how I try and view price action within the bigger scheme of the trend of the stock that we're focusing on.
yeah, yeah. Are you, when you're initially starting these positions, are you scaling in, or are you kind of going full position from moment one?
So I try and keep consistent size whenever I'm buying something. But like the way I like to kind of view a stock is again, that's where it's kind of nice to have the bigger view of like a William O'Neill, like you're looking for a base and an extended run. It's like you'll have time for multiple entries into a stock. So every piece is standardized, but like my aim is to always be able to buy a stock 2 or 3 times before it has its full extension. So that's kind of like always like the game plan I'm looking on. I just don't put it all on at once because the volatility can be too high, and then there's always event risk of like the next morning there's, I don't know, some kind of bad news that it could be anything. If it's an inflation market, it's a CPI report. If it's war, it's a war tweet. It could be whatever it is. There'll be the day you go heavy is the next day there'll be a gap down against you. So I've just
It's
learned to kind of.
uncanny how the timing works out like that too. The moment you're like, okay, I'm going big.
So
Oh, great.
even when I was like day trading, we would always have concentrated positions because you had stocks of responsibility or whatever. And so a lot of the stocks I was in charge of, or I was trading with the gold stocks. And so, you learn this early. Once you get slapped once or twice, you don't forget it. But like you would see these nice big moves, which in traditional technical analysis, oh, there's a breakout happening. But then every time, the first few times they go with size, and after it's like, oh, financing like that after hours. The next, oh, financing after hours. So it just became very clear when a finance is coming, especially in a stock that has a very low, like, very high cash burn or no cash on the books. Chances are it's the book runners making things look sweet before they try and offer it at a discount and saddle you overnight. So you learn very quickly that just all at night though before the next morning can sometimes be the most painful thing.
They there's always other players that I
Right.
think a lot of people don't take into account. So that's a good point. So now in doing all this, are you incorporating options at all, or are you just kind of straight equities on this?
I use options sometimes. It's always with the same kind of context of what I'm trying to capture. Like, especially around earnings reports, like just the moves have become so extreme, like these 20, 30% moves. And, I do like to get concentrated positions. Like I said, if the stock is going to go into a trend, like ultimately I'm going to have, a fairly concentrated position. And so earnings is this big issue. Now I know the options can get expensive, but the way I look at it is sometimes it's going to protect against the downside. Other times it'll be a drag when it goes up. If over time it's a wash, well, or a small drag, at least I don't have these massive event risks to my portfolio. And that's where you have to also think of like your I don't want to say mental health, but you don't want to drive yourself crazy. These 20, 30% gap downs, it could be quite hard to deal with. It takes time to kind of rebuild the confidence and all. So I'll use options in that situation. Sometimes if a stock is just extended, I'll buy some out of the money puts so that when things pull back, I have a nice floor that I can get aggressive against. So it's kind of like sometimes they'll just expire, but if it works out, it's like a good low risk way to add on a pullback. And like really, when we're in the depths of a market correction, I may start with some like call options or risk reversals to kind of get some exposure without having like a hard stop on every trade. Then the churn could really hurt you if you're just like, let's say tail end of March, the stocks are acting strong, but there's so much volatility that if you're using the regular, buy here, exit here, it's like, stop it after one after another gets expensive. So that's where options can kind of help. But I don't trade the options just for the sake of options, always within like the bigger picture of what we're trying to
Yeah,
accomplish.
always kind of in conjunction with your equity positions.
Right.
That's great. Now, what about so you talked a good bit about technical analysis and kind of these breakouts and trends and support and resistance areas and so on. Is that a big part of your focus? Is the technical side of it?
So I really try and run both. So all the timings, is chart focused. Like I won't buy a stock based on fundamentals, but I use fundamentals, past and also current forward estimates because I think the market is adapting much more rapidly than in the past to the future versus just the past. I'll really use that for like my universe and my focus list, which it's really important that you have a good. I think people underestimate the value of the effort of having a small focus list. It's kind of like, let's say you're a salesperson, right? Your leads are one of the most valuable things you can have besides the actual pitch you're going to give. So similar with trading, there's like thousands of stocks, and I always get this. Matt, how do you focus? How do you find that stock? Like, yeah, there has to be a big part of your process to just say like no to 99% and say this is the 1% is my wheelhouse. This is what I specialize in. And so that's really a lot where the fundamentals come in, but then all the timing and in terms of portfolio management and risk management is all pretty much the charts.
Pretty much, yeah.
Yeah.
And there is, there's so much the charts tell us, and we'll get
Mhm.
into a little bit more of that. But on kind of the fundamental side, I always like to kind of hear what people, what is kind of your top two or three favorite metrics that make a stock interesting for you on the fundamental side before you then
Mhm.
start to kind of look at the chart.
So what I always, and this may change in some scenarios, but typically I always want to see either the current year or at least forward estimates, even if it's 2 years out. I want to see like record earnings, record sales. I want to see like I don't really trade the cyclicals. So, and I know sometimes you come through a more of a corrective market, like maybe the current year may not be a record earnings, but the company is already guiding to record numbers in the future. So it just shows that they're winning in their industry. Whatever they have is under high demand, there's high growth. And then after, if the stock is basing with that backdrop, well, chances are it could be market related, causing the pullback or whatnot. And so that's kind of like one of the main metrics. So I'm not someone who's going to like dial in and I'll look at the balance sheet to make sure, like I mentioned before, if it's an earnings negative company, like are they imminently going to raise capital on me? Sell stock to raise capital and that kind of stuff. So I'll look at the metrics of the health of how the company is in terms of cash flow and the liquidity. But then beyond that, like I'm not going to try and do a valuation perspective, like, oh, this is cheap or expensive. I just want to understand, is this a company in a growth trajectory? And if it is, then the price action should kind of confirm whether it's under accumulation or distribution.
Yeah. That's great.
Yeah.
In kind of that searching, I mean, obviously there's a lot of scanners and screeners
Mhm.
out there for that type of thing. In some of that analysis, does AI play a role? Are you using AI to kind of run through some of these company details, or are you just going hardcore on it?
So that's like somewhere where it's become so helpful to have AI. So I still do all of the screening and scanning myself each week. And so I use two systems. I use one as like a typical screener. I like to use Market Surge, where you can screen by whatever earnings growth, sales growth, all your different screens, however you want to do it. And I like to use Portfolio 1, 2, 3, which is cool because you could do like a ranking system. So instead of like saying like, oh, it must have this, it must have that, it's like, so that way I have two snapshots. Like if I want to really focus on earnings, I can focus just on earnings in like a traditional screener. And if I just want to know, like, okay, well, in this environment, who are just maybe some of the better stocks? If I just look at a rank, like if I weigh all of these things together, maybe it's not the best sales, but man, they got killer earnings, or maybe those are not great, but man, the return on equity is phenomenal. So I kind of run that to kind of get my short list. And then once I have my short list, like especially in a market like this where there's so many new names and new developments, like I built like custom GPTs with Chat GPT where literally I put in the symbol. It's like, whoop, I got a 3 page like report of exactly all the recent catalysts, what are the main drivers, who are key competitors. And what used to take like one stock, 40 minutes going to the investor relation website and getting the presentations. And it's like now it's like literally like 1 minute. And then after, if I like it, then I could dive in deeper, but like massive time saver. Yeah.
Maybe it's because I have a little bit of tunnel vision and having a hedge fund and so on, and analysts that work for me. It I just feel like in the investing space, AI is
Mhm.
so helpful because there's so much data to just ingest and try to, like you said, I mean, our whole goal is to kind of have this big wide net that we spread and ultimately get it down to kind of these, several interesting ideas. And the help of AI in just that process, and I think some people think, oh, you can just ask AI, what do I buy? Which
Mhm.
maybe you can, and maybe some people do, but just getting through some of that ingesting all the information and kind of weeding out some of the bad stuff is just, man, it's so powerful for us traders. What a big help.
Oh,
So
amazing.
so that is super cool. So in this kind of market that we're in right now, where anytime things go well for long enough, people think crash is coming, everything's too
Mhm.
overpriced, it's all frothy, and so on. Where do you think some of the maybe the biggest opportunity is that people aren't talking about? I mean, obviously AI is everywhere, and
Mhm.
the tech kind of move, but I mean, where are you seeing some interesting opportunity?
So I do think that's the biggest. I think AI is the theme of this generation, of this moment, and it's what you have to focus on. But it's going to come through in different ways. I think just first of all, the reason the S&P is at all time highs, and I think this was, I don't know, we'll see get the final numbers, but this may be the biggest upside beat in earnings ever for the S&P for a quarter, which is amazing. And it's like I always say, because AI is the ultimate productivity tool, right? I mean, like Netflix changed how we watch TV, but I don't know if it's good for Netflix. I don't know if that's a productivity tool. You know what I mean? It's more of a time waster, but everyone is using AI primarily, is like productivity. So I think just like, I don't know if you're a fan of The Office, like with Michael Scott and all that, the TV show, like just like how the internet changed so many businesses, all there's companies with have so much value, think of it like the health business, like finding new drugs, new solutions. It transforms so many businesses where, you mentioned analysts, there's analysts in finance, analysts in research in so many capacities. You've just like given each person like an extra 5 people in terms of time that they can save to do more work. And that goes all to the bottom line. Like if it took you 10 months to discover a drug, I'm probably definitely shortcutting it, but let's say it took you 10 months, maybe you do it in 3. Like now you can
Yeah.
discover 3 drugs in the time of one drug. And that's like right to the bottom line. So I think, although AI I think is the main theme, and right now, people say AI, but they're basically all hardware stocks, whether it's chips or whatever kind of stuff, but it's going to permeate every industry. I just saw like garbage trucks are like at all time record margins, which is amazing, right? So it's kind of like it's permeating everywhere. Like figure out whoever is going to be able to kind of automate and become more productive is going to be a winner. And that's why I think this is going to be kind of like, I still say this is like the 90s, where you're going to get this wave of productivity that lifts the whole market for an extended period of time. And unfortunately, I think it was probably COVID burned a lot of people with the big drops after and all this kind of SPACs and all that. And it gave people like a negative view probably on markets, like what goes up must come down. But there's times where there's like immense productivity and like, wow, you can go on extended runs. I think we're in one of those scenarios.
Interesting. So you're looking for this to kind of, y- I mean, are you kind of feeling like a mid-cycle kind of vibe here? Like we've got a lot of time left to continue the growth and the assimilation of all the AI, the productivity that it's adding to these companies, and ultimately, bottom line, we've got a good bit left in your view.
I think, like I said, I think the biggest move to date has all been the hardware stuff, right? It's chips,
Yeah,
storage. Like even people saying like, oh, if the storage stocks fall, does that kill the AI trade? Well, like the storage is actually kind of become kind of a tax on everything AI, right? I mean, even like Apple has to start raising prices for his stuff because we need the
yeah,
storage and there's a bottleneck. It just happens. So if that alleviates, well, that just makes the building out of hardware cheaper, and then everyone's talking about how the token prices are falling and all that. Well, that's going to only like further accelerate, and that benefits everybody. So there's going to be obviously the market swoons. Look at July. What happened if you're on the wrong side of things? But just in terms of like the overall AI bull, like if you want to call the '90s the internet decade, although I mean it continued afterwards with we're still talking about Meta and Google, which is all essentially internet babies, right? In some capacity. But I still think there's a lot of time on the clock. Now, maybe some of the hardware stocks have had, a big part of their run. There's maybe another big hurrah before they peak some of them, or maybe not. But like I said, I think every think of every CEO, every investing committee, everyone's asking themselves, how do we not get run over by our competitors? What do we invest in? How do we become more productive? How do we incorporate this? And like I said, it's all a productivity tool. So I think this is going to be extended. It's going to get broader and broader, and I think it's going to be a wonderful wealth creation tool. Personally,
yeah, yeah. I
yeah.
it certainly appears to be headed that way for sure. So I mean, do you see what would you say is the biggest risk that nobody's talking about with all of this?
Well, the risk is, we saw with the optical stocks this year, where I think undoubtedly, eventually, we're going to stop using copper for a lot of the data transfer and use these like lasers to move data, and more and more. If you have all these data centers, but the point being is that at some point, I think it was early June, the CEO of Broadcom came out and says, we think people are a little too optimistic about like how quick that's going to happen. And then everything kind of sold off, because the market, it's all about positioning and what's priced in. So the risk is that just that people get ahead of themselves. That's certain turning points. Like I think so far, and maybe we'll get to that point, but like the dot-com bubble was really like that bubble was the fact that moves happened, partly was overbuild, but a lot of it was also based on companies that had nothing. It was all just like a wing and a prayer. Like I don't feel we're at that stage yet. I mean, even the companies that are IPOing have big businesses now. They're either not super profitable, but they're not like pets.com or just a whatever. So in terms of risk, I think the biggest risk is just, like we saw in South Korea, like over leverage, people getting too excited. It becomes too obvious. And so that's why all the more you need that technical analysis component, because that is the market mechanism reacting to the company fundamentals, which the stock is the combination of the two. So I think that's the biggest risk when you're trading is really positioning other traders probably.
Yeah, yeah. It is always amazing to watch kind of how technicals and fundamentals work together because
Hmm.
you can look at a stock and whatever kind of indicators you might be using, it's it's fairly common, I would say, for a
Hmm.
stock to get very overbought or very oversold and have certainly a technical component saying, yeah, we're here, and then some fundamentals underlying that, confirm that. And so it's always good using those two together. But I mean, we have these, all the memory stocks, chip stocks, and so on. I mean, is there an element there that somebody may not be considering? I mean, is it possible data centers, for example, we're spending trillions at this point building out these data
Hmm.
centers. I mean, what are the odds that we can figure out how to build a data center that can be a tenth the size and still pump out, the same computing power as some of these
Hmm.
huge ones we're building? I mean, is there I'm just always interested in people's take on this. So much money and this capex is
Yeah.
like through the roof in this space. Uh, I mean, are we gonna are these huge companies going to get hugely ahead of themselves in that kind of space?
Look, it's always I mean, look at just for example, I like cars. I think most traders like cars. I mean, look at how much horsepower a BMW M3 has today versus 20 years ago. It's the same company making this. They figured out how to make that engine more efficient. They're still selling the same number of cars, but I mean, like the real for sure they're going to find out ways to do more. And yeah, do you look back after and there's a big breakthrough where it's like, hey, Nvidia now their next chip is like 100x more efficient, and so we just don't need all this other stuff. It could happen, but like at a certain point, you have to kind of just deal with what's in front of you, because like the speculate, there's so many things that could happen. I mean, like you could say, just for argument's sake, China can invade Taiwan, and that cuts off critical minerals, and it starts a war, and then after everyone who's gonna have a data center, we have to stop that because we got to build war machine. I mean, there's like an endless series of possibilities. Just like that's like the negative side, and on the bullish side, like a guy like Musk, like visionary builder, but at the same time, like like he's been known to get a little too excited. Like, oh, we're going to have all these data centers in space and it'll be there and it'll be cheaper. Like, will that actually happen? So again, that's where it comes down to, do people like overpay in excitement? And then after you'll hit earnings periods where it's like, look, we can't deliver what you're expecting. And then it'll come through in price action. So that's why in terms of fundamentals, the reason I use both is I don't agree with I know people are going to say it's kind of counterintuitive, but I don't agree with the idea that I personally can figure out if this stock is too expensive or too cheap. And I say, well, someone has to figure it out. Yes and no, because I would argue that the collective of people trading are going to always know better than the individual. There could be someone with a lot of insider information, but it'll all flow through in price action. I know for sure, even if someone will figure it out, it probably won't be for me from my office figuring out if NVIDIA's next chip is going to be efficient enough. So there's just like, I mean, these scientists are building it in real time. If they don't know, and they're like, who just left Google to start his own AI firm, if they're like in the middle of this massive thing, how are us as investors who aren't even like the specialists in the field supposed to figure it out? So, that's why I feel like in this case, this situation, that's the price action is even more valuable to us. That's kind of how I kind of try and deal with all of it. Like, there's so much uncertainty. Like, with growth comes uncertainty, and that's why we get volatility. Right? Because then it's like the outcome constantly switches from it's going to be great. Oh my goodness, we overbuilt. Oh, it's going to be great. Oh, we overbuilt. And those are the swings,
Yeah. No, it's that's the truth. We sometimes you just have to, I had a trader tell me when I was early in my career, 20 plus years ago, he said, look, trade what you see. Don't trade
Mm-hmm.
what you want to see. Don't trade what you think you should be seeing. Just trade what you see.
Yeah.
And I've always kind of remembered that, when I get lost sometimes in all the data and opinions and thoughts and everything, you just have to go back to the basics. What's in front of me, right? How do I manage what I can see and work with right this moment? So,
Well,
so
what I always
yeah.
recommend people is I always say, like, build like a manual of like your process. If you have to teach somebody else, that's how you find the holes in your process. But part of my manual is like, just like what I find is like the eternal truths of trading. Like, I have a section of that with like these sayings, like you're saying. And actually, and so I also do the podcast, the Markets Unscripted podcast with my buddy Jason Shapiro, who was on this show. And one of what Jason's a smart dude, so like some of his saying, one of his sayings I love, just like similar to what you just mentioned, is he said you could think whatever you want, just like wait for the market to agree with you. Like if you think it's overvalued, but you're still like hitting new highs every day, just wait for a lower high. If like this is like 80% overvalued, you'll get a lower high somewhere. Or same thing, if you think it's the best buy ever, like you'll get a higher low, you'll get a tightening up of volatility before you go up. So I think that's at least that's my process, right? So.
Yeah, no, and I
Mhm.
think that's, and that kind of goes also with a little bit of the theme. I love getting people's take on. I actually wrote a little Substack on this, but buying the dip, right?
Mhm.
Buying the dip. That's, you always have people inevitably on both sides of that aisle, right? Of, dips can get cheaper. Dips are the only place to buy. How do you approach buying dips? Is that part of your process?
Yeah. So like, especially like we started at the beginning of the conversation. I was saying how early in a trend, breakouts work. And then later on, if the breakouts don't work, then you want to favor either volatility drives or pullbacks, dips. But that's one of those, like I always try and like tell people too, like the tricky part about trading is there's things that could be truths, but they're also don't really mean anything. So like buying the dip, if you don't define what dip is, what like is that a 4% pullback? Is it a 40% pullback? If it falls really, really deep, does that mean the whole story is not even valid? Like we were wrong about it the whole time either, completely? Or if you wait for 20 but it falls 15, do you never buy it unless it get that, or look at the April to May run up. Like everyone waited for the dip. And then when they finally dipped, they all fell like 50%. So like if you wait, you waited and then you just fell for the. So the way I like to do it is like kind of like I mentioned before. I have different like ways that I'll buy stocks on pullbacks, but they're for specific purposes. Like they're trying to identify things. So one is like I said, if you break the high out of a basing structure, when you pull back to the 21, I'll buy there because that's when momentum players should be shooken out. Now that I put a stop usually another 5% because now if you fall in 20%, maybe it's not a shakeout. Maybe the stock is just fundamentally has no upside strength. It should have rallied by now. And so what I like to do is go back over past stocks that are similar to the ones I'm trading. Like I have like model books and things, and so there's these different scenarios where the dips make sense, but then it should follow that path. And if it doesn't, I know when to exit. So whatever you do in the market, like my view is always you just have to always know when you're wrong. So if you just say buy the dip, but you can't define it, and then you can't figure out when you're wrong because you never defined it, then you're just buying falling prices. And so then you never know if you're right or wrong, right? You just you figure it out in what 5 years or whenever you decide to quit. So that's my view on the dip.
No, I think that's great. I mean, it's always an interesting topic because some people say, you can only, show me a stock that's been in a downtrend for a year and I'll tell you where it's time to buy it, or whether it's a small dip, right? A small breakout and
Mhm.
it's dipping the next 2 or 3 days and so on. And so I think I love what you said about, really defining what the dip means for you and your strategy. I think that's
Yeah,
amazing.
I mean, like a guy like Warren Buffett, right? Like he has, his view is I want to buy a great company at a good price. So I'm sure they have their metrics for that, and that's the way he buys the dip. It doesn't even have to necessarily mean the stock has to crash. It's just that versus the valuation. So you need a way to define what you're going to be because just falling prices is not good because sometimes prices fall for a reason, right? I mean, Peloton, which was the it stock at first during COVID, well, the dip, if you're still buying that dip, you're stuck with a pretty big dip there, So you have to identify it. That's all.
Dips can dip and they
Yeah,
can do nothing
exactly.
for a
A lot
long
more
time.
than you'd expect. So,
For sure, for sure. What's I mean, leave us with like a favorite stock company that you're liking, looking at, thinking about. What's a favorite chart?
well, as we talked today, NBIS had a really big up move today, and it's an
I
interesting
like
stock. One, the volatility is pretty wild, so you better strap yourself in. But whether you're trading it or not, it's a really good stock to watch because it's probably the canary in the coal mine for everything you mentioned about whether we overbuilt or whatnot. So this one and it's kind of like sister stock, CoreWeave is doing well because they kind of said like, we're taking on the argument's always they take on a lot of debt, right, to build this out. And they're saying we have backlog, but they say you still have to finance it. But both kind of show that they're building actually operating leverage. But people say like, oh, okay, so maybe there will be a business besides just renting chips and re-renting them higher, which I think was the wrong idea at the beginning. So I think that's like an interesting to watch. And again, the argument's strong when Michael, talking at the short side, Michael Burry just, I think at 210 said he was short NBIS when now earnings were strong. So I think that's one to watch very closely. I think some interesting stocks, if you want to go outside AI, things like maybe like Illumina, ILMN, which was like they were the first one to kind of, what's the right word, to decode the genome or, DNA like back
Yeah.
20, 25 years ago. They were back then it was a good example to your point. I don't know how much it cost them to like do the first analysis. And now it's like you can get these $30 tests, right? Or whatever it is. But so like they're starting to try and unlock AI for like building out health. It's not a big part of their business, but that's why everyone's kind of like, looking at how is that going to bump their productivity. So in health, they're like an interesting story and they've become strong. So those are kind of like some of the names. There's just so much moving. It's an interesting market for sure.
There certainly is. I think there's so you can definitely dig deep into that because a company like Illumina, which I've actually worked with Illumina on some
Okay.
unrelated projects, and they're I mean these guys can benefit so heavily
Hmm.
from. I mean, if nothing else, for all these companies, like you said, the productivity side of it, but it speeds things up. It
Yeah.
speeds things up so aggressively. Certainly, again, in the hedge fund investing space, my quant's taking months to put something together that I can now do on AI in a day or two, right?
Right. It's wild.
And so you just have this time value that is so accelerated with the intro of that. So that's great. Those are two good ones to keep an eye on.
You know, I
And
I would say
go
too
ahead.
though, like everyone should put on their Peter Lynch hat. Maybe people don't know Peter Lynch, but he was the big '90s like mutual fund guy, and his book, went up on Wall Street, saying his secret to success was just looking at what around him was new in his life that he was buying. I forget one example was I think some was like leggings that his wife was buying, or and it's just like, and I've really found that to be true over the years. Like I've been with my wife like a long time. It's like I remember when her and her friends were like, "Oh, Canada Goose, this is such a nice jacket," and then like it took off. You know what I mean? It's like, and, Lululemon, like, "Oh, look at these great leggings," and then this is like early, and then it became like the thing. Or I remember Netflix was one of my first big treats. Like, who wants to wait a blockbuster? You can just like get Netflix in the mail, or the streaming is fantastic. And so just kind of being aware. And so, like, to your point, like, I think what's interesting about AI that kind of also checks that box off is myself. Like, I call myself a power user. Is just like, it's like, if you're using it, if let's say you're working at Illumina, you're working at, let's say, Viva Systems, where they do like a lot of databases for health and all that kind of stuff. And if you're saying like, wow, we needed, either we needed 5 people to do the job of one, or now 5 people are doing the job of 30. Like, if you're noticing that, however, in your business, like, chances are that's going to go to the bottom line, and you guys are going to make a lot more money. So, like, this like quick innovative market is like the perfect time for that Peter Lynch mentality, in my point of view.
For sure, for sure. And I feel like that is, I talk to so many traders and fund managers and so on, and there's people out there that just say, I talked to one recently that said, I never buy tech. And I'm like, hmm. Like, in this market in
Right.
2026, you have no involvement in tech. And to his defense, he's done well and so on. But it's so interesting because I do, I mean, that Peter Lynch quote, and Peter Lynch is, he's great. I love Peter Lynch. And
Yeah.
and that whole look around at what people are buying and loving and using. And it does remind me, I had this killer trade whenever the big run up on American Eagle, AEO, right? The
Recently, like
clothing
last year.
retail. This was like kind of one of their earlier runs. So I think it was kind of
Okay.
post COVID, maybe
Okay.
21, 22, somewhere in that space. And I
Abercrombie
remember
took off as well, and all that kind of stuff, right?
totally, and
Yeah.
and they had these ridiculous runs, and I made a lot of money on those stocks. And I told my wife, I said, isn't it crazy that like Abercrombie and American Eagle are taking off running? And she tells me, no, all of our kids want to shop there now, and all
There
their
you
friends
go.
want to shop there. And I was like, why didn't I ask? Why didn't I ask? I
Yeah.
probably could
Yeah.
have got a
Yeah.
jump on the whole thing. So,
There
so,
you go.
so I think a big takeaway, and if I had to guess, one of your big underlying themes is some common sense. Keep your mind
Mm.
open and use some common sense. Watch the charts, see what people are doing. Have some rules for yourself and a plan that you follow. And I think that's just like such a valuable reminder for everybody involved in the market out there.
100%. And it's all a lot of the little things too. Like the situational awareness fund blew up. Why? Because they had too much leverage. Like don't oversize your positions. Like, probably more. Traders attract a certain personality. I think I'm included. People are very competitive, and so you tend to always want to oversize. And it's like you said, common sense. Like, sometimes forcing yourself back into, like, between the guardrails is just, that's the simple key to success that you're missing, because you're just like overdoing it sometimes, or like overthinking it, which is, sounds strange, but that could really hit traders sometimes.
Yeah, yeah. And
Yeah.
and the situational awareness story is, obviously so interesting in so many levels, but uh I always love to remind people, again, and a saying that I picked up along the way is, being too early and being wrong are kind of the same thing, right? and
100%.
and so, our poor situational awareness guy basically got margined out of everything before it all took off and ran up again. I mean,
Same thing happened with long-term capital management. Most of their trades worked out, but they got blown out before they got to the finish line. So that's just the reality of trading, right? That's to me, that's the beautiful thing, because I always say, like, the market. There's always going to be little things, but the market's pretty much the fairest place in the world. Like, you can't be a good trader just because your dad or your uncle was a good trader. You got to earn it, and that's
yeah.
just the way the rules of the market.
Yep,
Mm.
yep. No, it's a even playing field for sure,
Right.
and so, but that's why we love it. That's why we come back to it constantly. I love your takes on the market and your approach and so on. Tell my listeners where they can learn more about what you do and follow some of your research.
Absolutely. So you can go to carusoinsights.com. There I have a research product. I also have kind of like a, call it a mentorship, but really it's, I run a hypothetical portfolio. It's how I run my things day by day. So you can have a look there. Also, I'm on X with trader underscore M Caruso. And on YouTube, I have the Markets Unscripted podcast with my good friend, Jason Shapiro, who I think was on this show as well, like you said, 3 or 4 episodes ago. So
Yep.
what's fun doing the podcast with Jason, which, as we talk, is I think trading, eventually, when you do it long enough, you realize there's just the core principle. Not that it never becomes easy, but you realize what are the core truths and principles. And so I'm generally, as from this talk, a trend follower. and Jason's like a top and bottom picker. Like, we get along because it's like, yeah, even though we're looking for different things, the core process of how we trade is actually similar. So it's a fun podcast because we're all usually often on opposite sides, but basically with the same truth. So it's an interesting thing if ever you want to hear some chatting on Monday afternoons.
That's awesome. That's awesome. We'll post that link as well as your other links with this episode, and I think everyone will love that. So we'll keep an eye on it. But thanks for being on with us today. This was a great discussion. I appreciate your time.
Absolutely. Thanks for having me, Jared. Really appreciate it.
Thanks, Matt. Take care.